Hi everyone. Today I wanted to welcome you in my Great Capital Allocators and Investors series, where we talk about great minds of investing and what we can learn from them. Warren Buffett is probably one of the best investors in the wide world. Even if you are not interested in investing in the stock market, you probably have heard his name. But a lot of people associate him with investing in undervalued, cheap, or out of favor stocks. In my opinion, it is a misunderstanding of his brilliant investing mind, as he is a great businessman who understands a magnificent business when he sees one. Warren Edward Buffett is the chairman of Berkshire Hathaway, one of the biggest conglomerates in the world. Investing powerhouse he runs alongside his friend and another top investor, Charlie Munger, owns companies such as Geico, Burlington Northern Santa Fe, Berkshire Hathaway Energy Company, Clayton Homes, Fruit of the Loom, Duracell, NetJets, and that's just to mention a few. He's also a philanthropist who has committed 99% of his wealth to charity. But once in an interview, when asked how would he want to be remembered, he answered simply, a teacher. And I'm sure we have a lot to learn from him, and this is the purpose of this lecture, to learn from this brilliant man. But Warren himself hasn't figured out everything alone. He also had luck of having wonderful teachers, such as Benjamin Graham, who was a lecturer at Columbia University where Warren has studied. Ben Graham is regarded as father of security analysis, as he published a book about the subject where he dived deeply into the subject of fundamental analysis. He is also associated with value investing, but there is a huge misconception about what value investing is. Graham was known for investing for so-called net nets, which are stocks that you could buy on a stock market for less than value of their current assets. It was a conservative, relatively safe investing strategy, as you were pretty much buying a dollar for less than a dollar. He introduced a concept of margin of safety, where you should strive to buy a stock for less than its fair value, but applying a wider disproportion than just a couple percent, as you might be wrong in your analysis. Margin of safety was supposed to prevent you from losing money if you, for example, made a mistake and established a slightly higher valuation. In his early days, Warren has invested in a manner of Ben Graham, looking for cheap stocks and selling them with a profit. But what you need to understand is those stocks were cheap for a reason. They were not good companies. Nevertheless, Warren managed to make some money on them, and he decided with his associate, Charles Munger, to buy another cheap company in 1967, a textile business that was at the verge of bankruptcy, Berkshire Hathaway. Even though this name today is associated with the most successful company in history, initial purchase itself was a mistake, and a textile operation has been shut in 1985, which has been painful and prolonged decision, also because of worrying about the fate of the employees. Warren has been convinced by Munger that methods of Ben won't be working as they were scaling upwards and they needed to shift their strategy into quality. And this is where Phil Fisher philosophy comes in. Offer of common stocks and uncommon profits paid less attention to the price paid, but he focused rather on quality and growth of underlying investment. He's famous for his 15 rules of great stock. He focuses on matters such as market potential of increasing sales, management motivation to increase sales, effectiveness of research, sales organization, focus on profit margin, personal relations, and so on. Phil Fisher is also known for his brilliant investments at companies such as Motorola or Texas Instruments. This shift in Warren's mentality is best shown with his famous quote: "It's for better to buy a wonderful company at a fair price than a fair company at wonderful price." In the first part of his investing career, he was certainly buying for wonderful prices, but he only got fair companies, or I would even argue that the companies were bad, such as Berkshire itself. In annual letters to shareholders in 2022, he said it himself. At this point, a report card from me is appropriate. In 58 years of Berkshire management, most of my capital allocation decisions have been no better than so-so. In some cases also, bad moves by me have been rescued by very large doses of luck. Remember our escapes from near disasters at US Air and Solomon? I certainly do. Our satisfactory results have been the product of about a dozen truly good decisions. That would be about one every 5 years, and a sometimes forgotten advantage that favors long-term investors such as Berkshire. Let's take a peek behind the curtain. Later he mentions two of his best investments such as American Express or Coca-Cola. Berkshire purchase of Coca-Cola was huge at the time. They started buying in 1988, year after crash of Black Monday. They spent $1.3 billion of their capital to purchase the stock, which was a very substantial amount at the time. It's worth adding that cash with short-term instruments now for Berkshire is about $130 billion, so 100 times more than the initial investment. Of course, in nominal terms, inflation adjusted, that would be, of course, less. Was this a cheap stock? Warren said also, price is what you pay, value is what you get. And even at 18 PE, this stock might have been significantly undervalued. But how did they get this amazing growth opportunity? First of all, Warren and Charlie have studied every annual report of the company since its IPO. They noticed that this brand had traveled very well and was doing well in every country they started doing business in. At this moment, you cannot buy Coke only in two countries in the world, which are Cuba and North Korea. Brand itself is not strong only because it's known, it is strong also because it's associated with happiness. You might not even realize it at the moment of buying a can of Coke, but subconsciously, that's what happens. When studying every single annual report, they notice that the demand has been growing every single year. Every year they sold more cases than the previous year. Isn't that a great sign of a growth stock? Also, the business model itself was proving very efficient. It is capital efficient in a sense that company produces Coke syrup that was sold, and they didn't need the bottling plant themselves, which required less capital than doing everything alone. Also, Coca-Cola has a long track record of cooperation in different places, and companies even able to negotiate quite awesome deals and have restaurants agree to be the sole cola drink sold. You want to sell Coca-Cola? You can sell Pepsi. Also, go to any supermarket in your area. Would you be able to buy Coke if you wanted to? I bet you would. Currently, their position in Coca-Cola is valued at about $25 billion. Pretty hefty return, if you ask me. Also, from annual report, another quote: "The cash dividend we received from Coke in 1994 was $75 million. By 2022, the dividend has increased to $704 million. Growth occurred every year, just as certain as birthdays. All Charlie and I were required to do was cash Coke's quarterly dividend checks. We expect that those checks are highly likely to grow." Let's have a look at portfolio of Berkshire public equities, and please note that we talk only about stocks. This doesn't include wholly or mostly controlled subsidiaries, such as Geico, Syscandies, BNSF, and so on. Definitely not bad companies when you ask me, with number one being Apple, which in my eyes is one of the best companies around the world, having also one of the strongest consumer brands. Bank of America at second place is the biggest American bank, less of a grower but still strong company nonetheless. This company has been bought at the time when people thought that the financial system of the world has been destroyed with mortgage crisis of 2008. Number three is a company that Warren has named in his annual letter as a great decision. American Express, which has benefited from boom of credit cards. Number 4 is before mentioned Coca-Cola. And number 5 and 6 we have two petroleum companies. Those in my opinion are not so great, but maybe someone who studied deeply his decision about Chevron and Occidental can guide me on that. Just my take on the dozen good decisions that Warren Buffett made in Berkshire. I recommend you to look into those companies and try to understand why they bought them and what they saw in them. That would be great entry to study this truly brilliant investing mind. Those companies with no specific order are Coca-Cola, American Express, and my take, Geico, National Indemnity, Seas Candies, Nebraska Furniture Mart, BNSF, Berkshire Hathaway Energy, BYD, Apple, Gillette, and Bank of America. Thank you for watching, and please stay tuned for next episodes in this series of talking about great investors and capital allocators. Thank you for watching, and please leave a comment. What do you think about 1000 good decisions of Warren?